Very good morning to all of you. As some of you had mentioned, today is my last class. So welcome back to all of you. So like you're supposed to handle me for one more session. What we have covered PGBP, we have covered capital gain, and we have also covered income from other sources. So what basically I thought was we'll refresh whatever we studied in capital gain and income from other sources in a session. So probably we'll work out problems to get a feel of examination. So whatever we are solving right now will predominantly be your exam level questions, that is your past question papers or your from your revision test papers or suggested answers. So all of this, what we'll be testing today, will be from one of these previous questions, RTPs or suggested answer. And why is this important? If you actually look out your exam questions, it will be from one of this. It will be from study material, it will be from revision test paper or from suggested answer in this model at least. So the model or the approach will all be from one of this session. So that's all it is about. So what we'll do is we'll start with a problem. So we'll start with the problem, first problem from capital gain. So we'll start with capital gain. This was a problem which I didn't solve in the respective session. So when we handle capital gain, we had to skip this problem. So what I'll do is I'll just discuss about this particular problem. Okay. So this is about an urban agriculture land was sold by A on 25th November 2022. So what is the value of sales? He sold it for 75 lakhs. So on November 2022, the land was used for agriculture purpose for several years. For several years, he acquired that land in 1979. So the land, whatever was actually purchased, give me a second. So the land which was actually purchased was for agriculture purpose. So it is important to know that it is urban agriculture land and not rural agriculture land. So when we say rural agriculture land, it is not at all an asset. When you say urban agriculture land, it becomes a capital asset. So that's why it is important to know whether it is urban agriculture land or rural agriculture land. And moving on, it says that he acquired that land in 1979. He acquired that land in 1979 for 2.5 lakhs. So when it is acquired before 2001, it is important that the fair market value of 2001 will be considered as your valuation, correct? So that's what is important. So it says that 1979, the market value of such land on 1st April 2001 was 20 lakhs because it's important. The fair market value of the property on 1st April 2001 is important. The stamp duty value was also 20 lakhs. We discussed in earlier classes that when the stamp duty value is lower than the fair market value, when the stamp duty value is lower than the fair market value, you can always adopt the stamp duty value itself. So because stamp duty value is the base, so stamp duty value or fair market value, whichever is lower, will be considered. And he purchased rural agriculture land for 8 lakhs. So on selling that, he has invested in a rural agriculture land for how much? For 8 lakhs on 25th January 2023. So subsequently, after purchasing this, he has sold it on 18 June 2023. So he has purchased the rural agriculture land on 25th January 2023, but he has sold that agriculture land on 18th June 2023 for 13,50,000. A sum of 16,25,000 was also invested by him in the purchase of residential property on 25th June 2023. He did not own any house property before this date. When we are talking about all the chapters like be it PGBP, be it capital gain, or be it income from other sources, when we are solving problems, we said one particular thing repeatedly. We said certain things in your problem is a value addition, gives information to you, which is useful for the solution. Certain information is not relevant. Might be just to confuse you or just to leave it as it is. Whatever it is, you have to have the capacity to differentiate between what is relevant for your problem, what is not relevant for your problem. How do you know that? When you have a strong foundation on the provisions and when you repeatedly work out problems, you will know what is relevant, what is not relevant. For example, it says he did not own any house. He did not own any house before this date, which means they're trying to say this is his first property. Where does the condition come that to claim this exemption, he should not have any other property. He should not have more than one property other than the property that he is currently investing. There is an exemption which talks about the restriction of number of house properties you can have at the time of claiming exemption. So that is what section? That is section 54F. So this is what it is about. So now it says he doesn't own anything. The new house property, whatever he purchased, is again selling it on 28th August 2023 for 17 lakhs. Generally, there is a period of how much time? Generally, there is a period of 3 lakhs, 3 years, right? Within 3 years, if he is selling this property, then it will be treated as the exemption will be withdrawn and it will be treated as the capital gain in that year. So now we are going to solve it for 2 years. So not just assessment at 23-24, they also want us to solve for 24-25. Why? Because of this transaction. We need to know whether what is the taxability in 24-25. So they have given the basic indexation slab. So as I told you, these two slabs, this is 100 and 331. You need not even remember. You can just please keep it off as if it is always there in your mind. So these two exemptions, these two indexation of year 2001-2 and 2024-25, it is important that you always remember, because 21-22 is the base year, that is 100, and the 22-23 is the year in which it is applicable for your examination. So it will be like 331. So these two things should always be there in mind. But as I told you, exam will always provide you with this numbers. Indexation numbers. Okay, so we will start solving this problem. Okay, so typically we'll take it as question 1. It pertains to what? Mr. A, right? So we'll say computation of capital gain of Mr. A for AY 2023-24. So what are the columns required? You need to have a particulars column. You need to have an amount column. If required, you can have 2 amount columns. But here we are going to solve only one capital gain alone. So you can restrict it to one single column also. So then reference column, correct? So this is what you have to prepare for the problem. So you start with these basic structure. So as you keep solving, you will know exactly the space that is required, exactly the quantum of for each head, what will be the number of line items that is required. All that will come in practice. As I told you, keep writing the whole problem at the same time. So whenever you have working notes, understand the space that is required. Start the working notes below the space. So that's what will help you in saving time when you solve a problem. So this says, what does the question says? It says he's selling an agriculture land. The first thing that we need to work is for agriculture land. So sale consideration. Sale consideration is 75 lakhs, correct? So he is selling this property for 75 lakhs. Now what should you do? You should less indexed cost of acquisition. So what is the index cost of acquisition? We need to calculate. We can always calculate it in a note or put here itself. It is up to us. So however you want to do, you can write. So since there is fair market value, there is this stamp duty value, everything is there. Maybe you can give it as a note itself. Then what you get the before you write this index cost of acquisition, we should always make sure that there are no other expenses. If there is expenses, the first thing you need to do is less selling expenses, get the net sale consideration, and then go to the cost of acquisition. So the index cost of acquisition is typically both the fair market value and the stamp duty value is 20 lakhs. So it can always be 20 lakhs into your divided by 100 into 331. So for time being, we'll write it here and then probably we'll go in the note. So it is basically 20 divided by 100 into 331. That is 20 lakhs. Okay. Just for the time being, I'm writing it here. Then we'll write it detail in the note. So what will be the number? So 20 lakhs divided by 100 into 331. So it is 66 lakh 20,000. So this 66 lakh 20,000 will give your what? Will give the capital gain. That is your long-term capital gain. So long-term capital gain will be 75 lakhs minus 66 lakh 20,000. So it is 8 lakh 80,000. This 8 lakh 80,000, he has invested, right? He has invested. So what he has invested? First thing is he has invested in a, for 8 lakhs, he is invested in a, this what you call, he has invested in an rural agriculture land. So this selling an agriculture land, buying an agriculture land comes under section 54B, right? So selling an agriculture land, buying an agriculture land comes in 54B. What does it say? It says the urban agriculture land which is sold must have been used for agriculture purpose for at least 2 years immediately preceding the date of transfer, not year and all, immediately preceding the date of transfer. In that 2 years, it could be used for agriculture by him or his parents, right? So this individual or the parents could have used the agriculture land. Now here it says he has been using it for agriculture purpose for several years. So which means they have used the word several. So it is assumed the several is something more than 2 years. So now this investment is an eligible investment less exemption under section 54B is 8 lakhs. Okay. Next, he has also invested in a residential house property, which is his first house property. So selling an asset other than land and building, understand land alone is not an asset that is covered under section 54 or 54F. Both 54 and 54F sell a residential house, buy a residential house, correct? 54F. 54 specifically talks about sell a residential house, buy a residential house. But 54F sell any other asset other than land and building and then purchase a residential house. So you have to sell anything other than this residential house, but purchase a land and building. So what has happened? Now he has purchased this residential house. So this residential house, what he has sold is urban agriculture land. So there is no building on it. Now he is buying it for, on 25th June 2023, he has invested 16,25,000. So what is it? For exemption under section 54, exemption under section 54F, you will have to take the whatever he has invested. So whatever he has invested is 16,25,000 in the proportion of your capital gain to net sale consideration. So divided by 8,80,000. So that is your capital gain, 8,80,000 into your total whatever you have invested. So 75 lakhs. So this will be your total investment. So whatever it is, so 16,25,000 divided by this. Sorry, I've just put the numbers wrong. So 16,25,000 divided by 75 lakhs into 8.8 lakhs, correct? So 16,25,000 is for 75 lakhs. How much is it for 8.8 lakhs? So you have to calculate this, but restricted to your capital gain. It cannot go beyond capital gain. So you can write this also as a note. You can write all these in a note. For time being, if you compute 16,25,000 divided by 75 lakh into 8,80,000, you will get something, you will get a number, right? 16,25,000 divided by 75 lakhs into 8,80,000. So it is 1,90,000 667. So it is 1,90,000. But it is restricted to how much? 80,000, correct? So it is restricted to 80,000. So your long-term capital gain will be nil. Why? Because your 54F cannot give you a loss. These are exemptions that cannot give you a loss. Exemptions are always limited to your available income. So your available income currently is only 80,000. So you restrict it to 80,000. So 80,000 is provided and you get a nil. So what is happening? Now this is finally being sold. This is sold in 24-24 assessment year. So 24-25 assessment year, this property is finally sold. So now you take this property and compute for 24-25 what will happen in that particular year. So you do the same thing. You do computation of capital gain and capital gain of Mr. A, right? Mr. A for assessment year 24-25. So particulars amount and reference. So again, so I'll have a table. So now whatever I do is a short-term capital gain, correct? So sale consideration. So what is my sale consideration? 17 lakhs. So sale consideration is 17 lakhs. Now less cost of acquisition, that is whatever it is, that is 16,25,000. So cost of acquisition is actually how much? So whatever he has invested is 16,25,000. So 16,25,000 on that he has actually calculated this particular thing. This 17 lakhs is actually sold in 16,25,000. Now in this 16,25,000, whatever has been done, what exactly is happening is now this 16,25,000 he has claimed how much? He has claimed 54F for already for 80,000. That is, he has already claimed 54F for 80,000 in the year. So that cannot be considered as a cost. So now he is selling it within 2 years. He is selling it within 2 years. So the first thing that we need to see is 25th November 22. So 1 year backward, 2 year forward for purchase, right? Purchase. So 22, he can purchase till 24th November 24. So he has already purchased it only in 25th June 2023. So now we have already claimed it under section 54F. How much have we claimed? 80,000. So this 80,000 cannot be claimed as a cost of acquisition. So it will be reduced from your cost of acquisition. So your cost of acquisition will be 16,25,000 minus 80,000. So typically it will be how much? 16,25,000 minus 80,000. So 16,25,000 minus 80,000. That will give you 15,45,000. So your capital gain that is short term will be 1,55,000. Correct? It will be 1,55,000. So now we are adjusting that 80,000 in cost because he has already claimed it as an exemption. So that's what it is. Now there could be another alternate solution to this also. Another alternate solution to this also. What it does? It says he purchased rural agriculture land of 8 lakhs on 25th, which was sold for 13.5 lakhs on 18th June 2023. So basically, there is no capital gain on the sale of agriculture land. That also has to be mentioned in the note, saying that sale of agriculture land is ignored. But he has invested on 25th June 2023, correct? What he has invested on 25th June 23 is after selling rural agriculture land. So first he sells urban agriculture land, okay, urban agriculture land, then sells rural agriculture land. So you can take a position that 16,25,000 was from the sale made of rural agriculture land. So the 16 lakh, the sale was from this particular land, and ends. And basically, we can say that he is not claiming 54F itself. He is not claiming 54F because it is assumed that he has invested that residential house from the funds of rural agriculture land, which means rural agriculture land is not a capital asset. Because of that, what you can do is you need not reduce this. So this need not be reduced. Because if you are taking an alternate solution whereby you are not giving exemption 54F, because you say 54F, that is 16,25,000 is invested out of the funds from rural agriculture land and not from urban agriculture land. So we are restricting itself to this particular sale only. So in that case, what happens? This will be 16,25,000. So this will become 16,25,000 and this will become 75,000. This is an alternate solution. As far as income tax, there need not be one single answer also. There could be several answers, but all you have to make sure is write it very clearly. You could see in many of your RTPs or suggested answer, they will give you an alternate solution. So which means there is always possibility of another solution. We never know. So in this case also, Section 54F can be claimed, cannot be claimed also. How do you say that it cannot be claimed? There must be a valid reason, because exemptions are not exemptions. Why should someone ignore an exemption? So you can always say that exemption was not considered because it was invested out of rural agriculture land. So in that case, 54F will not come itself. But since it satisfies all this condition, you can always say that I have claimed 54F and subsequently taxing it. So both are right. Whatever we have followed is the first straightforward approach where we have claimed 54F for 80,000 and subsequently, since we are selling it within 2 years, we are claiming it. We are also saying that in the note that the sale of rural agriculture land agriculture land is not a capital asset. Hence, sale of agriculture land will not be considered for the purpose of computing capital gain. So all this has to come in the note. Okay. So the first one is basically computing the indexation. So as we said, notes are very important. So how do you write? So in the first note, probably you'll have to tell. In the first note, you will have to tell indexation. Okay, you will have to say that the fair market value, stamp duty value. Since the fair market value and stamp duty value are same, the fair market value is considered for the purpose of indexation, and then index it. So you are very clearly saying that you know the provision for fair market value and stamp duty value. As I told you, it is very important that you let the valuer know that you know. You let the valuer know that you know the provision. That is very important. That happens only through notes. So you say this in indexation. You say in indexation very clearly that fair market value or stamp duty, whichever is lower, will be considered. So since stamp duty value and fair market value are same, you are considering the fair market value and indexing it from 100. So that's what it is about. Similarly, for exemption 2, you say that it is assumed the residential house is purchased from the funds on whatever is sold, the urban agriculture land. The investment of 54F is based on the funds from the sale of agriculture land, for sale of urban agriculture land. Hence, 54F is covered. However, 54F is restricted to available capital gain. Available capital gain. So the available capital gain is 80,000. So we have restricted to that. So that also should be brought into it. And you can also add a note here of saying, for this particular thing, you can say it is note number 3 and say the 80,000, the cost of acquisition needs to be adjusted from the cost of acquisition because the property is sold. The residential house is sold within 2 years from the date of purchase. So because of that, within 3 years from the date of purchase. So the capital gain, the cost of acquisition will be adjusted with this 80,000. So that's what the 3 notes you write. So you write about 54F, then you're about withdrawal of 54F. Withdrawal of 54F. So these are 3 notes that you have specifically you need to cover it and explain your assumptions or your stand for the computing the problems. So that is about exercise 1. Okay. So I'll see if there are any questions in this question 1. Shivlani, answer of last 4 questions of capital gain in the PPT is not uploaded by you. Yes, I have not solved it at that time in the examination. So we are solving it right now. So whatever we are solving now is the first 4 questions, whatever I have given is there. Abdul, you did not upload IFO slides. I'm sorry, I'll do it today. The slides and the notes, I will upload it today. I just wanted to remove problems that was not solved during that class. So I'll remove it and upload it by today. Dhyanesh, never repeat questions of concept asked in previous attempt. That's false. That is never the case. Your concepts will be case. Maybe things like capital gain about exemption may not be in the immediate next exam, but there is no procedure which says that it will not be repeated at all. It will definitely be repeated. And if you see, there will always be a pattern. There will be a question on TDS for which you have to answer. There will be a question on total computation for 14 marks that you need to answer. The adjustments in that 14 marks will be typically whatever you have been following over the period. There will be hardly anything that is completely fresh. Please understand this. There will be something that there will be hardly anything that is completely fresh. Most of the problems will be something based on what you have already worked in the study material in the RTP or suggested answer or previous year question paper. So the concept repeats. The concept repeats in your examination. So by solving more and more problems from these materials, study material, RTP, suggested answer, and your previous question paper, you will have a complete grip on what is questioned. As far as income tax, the only thing that will change is generally in every year question paper, the importance would have been given to amendments. That year amendments will be important. But so when you're computing, let's say last year's question paper or previous year question paper, some of the questions might not be actually relevant for this period because it was exclusively for that amendment at that point in time. But the questions or the concepts repeats. Capital gain on index cost of acquisition is always long-term capital gain. Dhyanesh, yeah, correct. So it is 54F is restricted to capital gain. Arun, is it compulsory to write all the sections? See, I will actually put it this way. Things like exemptions, capital gain exemptions, you must know the sections. There are hardly 5 sections. But other than that, writing sections will give more confidence to the valuer that you know the provisions. But writing the provisions wrongly also, the section numbers wrongly also might give a completely different picture. So what I would suggest is for certain sections, which I have stressed during my classes, during PGBP and other things, it's better that you remember those sections. For example, section 32 depreciation, remember, it is important because whenever you have a question on depreciation, you will have about section 32. Whenever you question on PGBP, you will have about depreciation. Your scientific research, section 35. There are very key sections which we have pointed out in PGBP, in capital gain and all. But everything else like section 48, section 29 or 45, whatever we're saying, need not be remembered. So there are important sections that you need to remember. There are sections that you need to mandatorily quote, like these exemption sections. when you're writing exemptions in capital, it is compulsory to write the section. So it is important that you basically understand the section. So that's what it is about. Gomati, yeah, I have not uploaded IFOs. I'll definitely include it. Mohammad Aslam, house property will not be included because it is purchased from the funds of sale of agricultural land. Exactly correct, is Aslam. See, as I told you, these are two views. You can always take your view. You are completely fine. It is completely fine that you are taking the view of saying that it is purchased from the agricultural land. It is completely fine. Just that it is a view that you are taking. So whatever it is, make sure you are writing it as a note. Writing is, and don't think that valuer will know that you did not include 54F because it was considered from the sale of agricultural land. Don't think that you must write very clearly that it is from this particular assumption. So the assumption is very clear, should be very clear, because when you're claiming 54F in the question paper, you should always write it in the subsequent period that this must be ignored. So that's what it is about. So it is very clearly it is important that you mention it in the note. So that's what it is about. Okay. So with that, okay, there is some more question. We need to write direct tax and indirect tax in the same supplementary or separate supplementary. It's in the same supplementary. It's just part A and part B. So you can write it in the same thing. Okay, good. So we'll move on to the next question. That is question 2 of capital gain. So in the capital gain, we'll see another question, which is typically is again on capital gain. So R owns several assets that are listed below, and he is also sold those assets during financial year 22-23. So the first thing is he's selling a residential house that was inherited from his father in May 1978. It was built at a cost of 1,20,000 by his father in 1976. So it is a property which has come to him by what? By inheritance. So what happens? Inheritance, automatically you need to say that the father's cost is the cost of acquisition, and indexation also can happen from the father's share on the basis of a case law. So basis of Manjula J. Shah. So whenever you are indexing based on fathers or inheritance or previous owners indexation, you must write this word. The indexation is based on the ruling of Manjula J. Shah. So that is very important. If you can remember this name in some combination, it will always be good. So inheritance from his father in May 1978. It was built at a cost of 1,20,000. An addition was made by R for 2,20,000 in June 2003. So it is after financial year 2000-2001. So after 1st April 2001. So this improvement needs to be considered. 1st April, it was 11 lakh, whereas your stamp duty value is only 10 lakh. So your stamp duty value or this, whichever is lower, should be considered. So now what do you consider? You consider this 10 lakh as the thing. Alternation additions are made in. Again, there is another improvement in for another 2.3 lakhs in 2011. So this property was sold. For 4,40,000 in July 2022. So 4,40,000 in July 2022. The selling expense were 30,000 on brokerage, etc. So the selling expense is also given. So whenever you're writing selling consideration, you're supposed to reduce the expenditure. He purchased another residential house for 3 lakh in March 2023. Listed shares sold for 2,10,000 on 5th November 2022. These are purchased in October 2016 for 2 lakhs. FMV as on 31st January 2018 was 2,40,000. So they've given you the fair market value. So basically, they've also said it's listed shares. So it is assumed it is transferred to the recognized stock exchange and it has suffered STT. Sale of listed debentures, 1,20,000. These are purchased in August 2013 for 1,10,000. So it is about listed debenture. We need to see whether for this indexation is applicable or not applicable. So we said it's only for listed equity share, listed units is where this 112A comes into picture. For rest of the it is 112. So 4th September 22 he has purchased. which is he has purchased in 2013 and he is selling it in 2022. So almost I think everything is a long-term capital gain, correct? So everything is about long-term capital gain. So now we need to compute capital gain for the next thing. So compute capital gain of Mr. R for assessment year 2023-24. So particulars, amount, reference column. Okay. So he has 3 assets. So of course there will be space. Okay. So these are standard things that you need to do once you start a question. So first understand what you need to do. So first take time in reading the question, understand what you need to do. While reading the question itself, you have to just see whether what all adjustments you need to do, what all notes you need to write. So just start visualizing what all you have to write it in the question paper when you're reading the question. So understand the question, visualize, and then solve. So please keep this as an habit. Understand, visualize, and only then you'll have to solve. So now what is that? There is 3 properties, 3 capital gains we need to discuss. First one is about the sale of an house which he has inherited. And the second one is about listed equity share. So the 31st January 18 fair market value comes into picture. The third one is a listed debenture. When it's listed debenture, it is still whatever it is. We need to see whether it must be indexed or not. So we said indexation is not applicable for certain things. We need to see whether it falls under that perspective. So these are the things that we need to keep in mind as far as your as far as your solution is concerned. So it's very clearly that we need to calculate all these things. So we'll start with the residential house itself. So the first thing is residential house. So residential house, we have to start with sale consideration. So that is the basic for everything. So how much is sale consideration? It was finally sold for 44 lakhs, correct? So 44 lakhs in July 22. So 44 lakh less there is a selling expense, correct? Selling expense. So how much was it? It was 30,000, correct? It was 30,000. So it's a brokerage. So you get net sale consideration. Net sale consideration is 43 lakh 70,000. In this, you less index cost of acquisition. So you can always write this in note 1 because as I told you, the fair market value is different. The stamp duty value is different. The fair market value is 11 lakhs. The fair market value is 11 lakhs, whereas the stamp duty value is 10 lakhs. So fair market value or stamp duty value, whichever is lower. So when it comes to a building, stamp duty value is the basis. So you can always take stamp duty value even if it is lower than fair market value. So it is 10 lakhs. So you have to write in the note. What should you write? For the purpose of cost of acquisition for the property acquired before 1st April 2001, the fair market value or the stamp duty value, whichever is lower, will be considered as the cost of acquisition. The cost of acquisition needs to be indexed from the year of the previous owners base year on the basis of ruling from Manjula Jesha. It is all important because otherwise, so typically, let's say he has actually, in this question, it may not matter much because he himself has got it before 2001. Correct? He himself has got it before 2001. So either you take father's year or son's year, it is still 2001. But there will be questions which are different. There will be 1 year before 2001, the other year, that is son acquiring, might be after 2001. So you have to make it very clear. You have to make it very clear that this is basically based on the ruling of Manjula Jesha. So remember this case every time, Manjula Jesha. So the indexation of father's year, the indexation of father's years is based on this ruling, not based on the Income Tax Act. Income Tax Act says index it from the first year in which assessee is the owner. So when you say assessee, automatically it becomes the second owner, the son. So you have to use the indexation of owner's year, that is second owners, that is the son's year if it's father to son. So it is different. So you have to choose which method to follow. So the preferred thing is quote this case law, Manjula Jesha's case law, and always follow this base year as the original owner's base year. So what is it? It is 10 lakhs. So as I told you, you have to write it in a note. For just calculation purpose, I'll write it here. So 10 divided by 100 into 331. So how much it will be? It will be 1 by 10, right? So 1 by 10 is, so it will be 33 lakh 10,000. Correct? Is that right? I think it's right? So 331. So this will be, I'll just check once, right? So 10 divided by 100 into 330. So it is 33 lakh 10,000, 10 lakhs. Okay. So now the index cost of acquisition is this much. So whatever it is calculated is based on this. So whatever now you do, you can either take all these exemptions before it, calculate the index cost of acquisition, and then calculate the index cost of improvement. So there should always be the order that you are following. So first is sale consideration. We saw the structure in section 48. First is sale consideration, less selling expenses. You get the net sale consideration. From net sale consideration, you reduce. If it's long-term, index cost of acquisition, index cost of improvement, and then finally you get your capital gain. So here there are a couple of improvements. So index cost of improvement. Index cost of improvement. You can call the year. Okay, improvement made in which year? The one was made in 2003. So you can call of the 2003. Okay. So 2003's indexation. This is, so improvement, sorry. So indexation of that improvement. How much is it? It was improved for 2,20,000. So in the year June 2003. So we need the 2003 force indexation. So they've given it as 109. And of course you have to index it till 331. So what happens? 2,20,000, right? 2,20,000. 2,20,000 divided by 109 into 331. So it is 2,20,000 divided by 109 into 331. It is 6,68,073. 6,68,073. And then again another index cost of improvement. This happened in 2011, February 2011. So it is 10/11, financial year 10/11. So we need to adopt 167. So that is 2,30,000. So 2,30,000 divided by 167 into 331. Correct? So 167, 2,30,000. So it is 455,868. 455,868. So 43,70,000 minus 33,10,000 minus 668 073 minus 455,868. So it gives a loss of 63,941. So it is loss from long-term capital gain. So there is a loss of 63,941. Next is we have to do it for the invested. Next is equity share, right? So equity share. So whatever equity share he has been following needs to be considered. So now equity share, for equity share we'll start with again. So next thing is sale consideration. Since it's a loss, there is no exemption that can be claimed. Correct? Because the question says that he has invested in a residential house. So selling a residential house, buying a residential house, he could have claimed under section 54, but since it's a loss, he cannot claim. He cannot claim this residential house. So next is equity share. So the sale consideration of equity share is sold for 2,10,000. 2,10,000 on 5th November. So you take 2,10,000 less cost of acquisition. So for this, you'll have to write a note. We'll have to write a note. For this also, you can write a note saying that residential house investment is eligible for under section 54. However, since it is a loss, it cannot be claimed. You can always write extra, right? Always write extra to give extra information to the valuer, but make sure you know the provision very well before writing it. So now the cost of acquisition is basically whichever is higher, that is your cost, and then whichever is lower, that is fair market value and sale consideration. So this is what needs to be considered. The cost here is 2 lakhs, correct? So the cost is 2 lakhs. The fair market value on 31st January 2018 was 2.4 lakhs. And sale consideration is, how much was sale consideration? 2,10,000. So 2,10,000. So fair market value or sale consideration, whichever is lower. So 2.4 or 2.1, 2.4 or 2.1, whichever is lower. So you take 2.1. Cost or sale consideration, whichever is lower. So what you do is you take the entire 2,10,000. You take the entire 2,10,000. So it will be long-term capital gain. Long-term capital gain will be nil. So we continue till here. So long-term capital gain shall be nil. Correct. So your long-term capital gain on sale of equity share. So you can always write numbers here: 2 equity share and one residential house. So start with the nature of asset so that you have that continuation. So the third asset is listed debenture. For bonds and debentures, indexation is not required. Bonds and debentures, indexation is not required. So whatever it is, the cost, the actual cost, whichever here he has purchased, you straight away take it. So for listed debenture, you take the sale consideration. Sale consideration, it is how much? It is 1,20,000. And cost is 1,10,000. So 1,20,000 less cost of acquisition. Cost of acquisition, that is, you write note 4 and say 1,10,000. You say that for bonds and debentures, the indexation is not allowed under section 48. So it is cost of acquisition is your index cost of acquisition. So your capital gain, your long-term capital gain, will be 10,000. Now, what does the question require? Do they require the whole gain, or how should it be reported? Compute the capital gain. So what you can do is, everything is long term. So what we can do is total capital gain, correct? Capital gain, long term, will be a loss, that is 53,941. So it is a loss of 53,941. So this is what you have to do. So you have, as I told you, note 1, you have to write about. In note 1 is about your index cost of acquisition. Index cost of acquisition, you have to say that stamp duty value or FMV, whichever is lower. So whichever is lower, so you have considered stamp duty value and index. So that's important that you need to say. Second is 54 exemption. You say that not eligible as the sale of house results in a loss. So hence 54 cannot be claimed. Third, we spoke about cost of acquisition for equity share. So you'll have to write that whatever we wrote there, right? So we'll have to write the computation of cost of acquisition for share before purchased on or before 31st January 2018. And fourth thing is you take this indexation. This is also for indexation. You'll have to say it is not eligible. We'll have to say it is not eligible. So that's what this is about. So that is all about question 2. I'll see if there are any queries on this. Mohammed, is it from urban or rural, and is the answer same in rural funds? So as I told you in the first problem, if you assume that the house property was just purchased from rural agriculture land, then there is no 54F at all from that sale of urban agriculture land. So it is not applicable at all. So whatever stand we said, there are 2 ways of solving that problem. Whatever it is, be clear in your notes. Abdul, why you didn't reduce index cost of improvement from sale consideration? Where are we talking about? See, if it is about debenture, you are talking about, if it's debenture that you are talking about, then it is, if it is the previous question you are talking about, it was sold within 2 years. It was sold within 2 years, so it was not indexed. And additions is 2,30,000. I've specified the number wrongly somewhere, is it? I think I've considered as 2,30,000 only. Mohammad Aslam, I have been repeatedly getting a question. See, what I'm trying to tell you is, let me repeat it again. This 54F is under the assumption that it is out of funds of, say, urban agriculture land. It is out of urban because you have got 75 lakhs. You have got 75 lakhs and you have invested only 8 lakhs. So it is assumed it is from urban agriculture land. Whereas in the second assumption, that is, if you think it is from the sale of rural agriculture land, if it is from the sale of rural agriculture land, the rural agriculture land was only sold for 13 lakhs, but you have purchased a property for 16,25,000. If you're still taking that assumption, you should not give 54F in this particular situation and then write it in the note saying hence it is ignored. And in that case, this cost will be 16 lakhs. So you can take both the views. whichever is comfortable by you. So the answer is not, it will be the same if you treat urban or rural, it is not same. The answer will differ if you treat the second, that house investment from urban or rural. If it is from urban, you give 54F and adjust it with the cost of acquisition. If it is rural, you don't give 54F there, you don't adjust cost of acquisition here. I have marked it in red. I've written it red. What happens if it is not without? What if it's happened not without the not without claiming this 54 exemption? So the red in the first question pertains to what happens if you are not claiming 54F. Okay, so that is question number 2. Okay, so we'll move on to the next question, that is question number 3. So what is question number 3? It is also on capital gain. So it is basically or purchased a plot of 8,50,000. He purchased a flat of 8,50,000 in 1-2. So and it was sold. It is sold in 10th June 2022 for 32 lakhs. So 10th June 2022 for 32 lakhs. So he has sold it for 32 lakhs. He has purchased it for 8.5 lakhs. It's a plot. He paid 14,000 as brokerage charges. He invested 4 lakh in bonds of NHA on 28th August 2022. So we need to see whether it is within 6 months. And 6 lakh in the purchase of one residential house in 15th June 2023. Correct? So this is what he has basically done. So the first thing is, we'll solve it here itself because there is some gap here. So sale consideration is how much? Is 32 lakhs. It is purchased in 1-2, so less index cost of acquisition. So it will be 8,500 into 331. That is 28 lakh 13,500. Three lakh 86,500. Oh, we have to reduce the expense also. See, what we'll do is I'll just rephrase this question because it's looked like we'll not claim anything. There will be no gains. What we'll do is we'll make this as 42 lakhs. So we will change this to 42 lakhs. Okay, we'll change this to 42 lakhs. So I'll anyways correct it in my slide when I'm updating. So we'll solve it with 42 lakhs. So sale consideration is 42 lakhs less expense. Expense is 40,000. Okay. So you get it as 41 lakh 60,000. Correct. You get it as 41 lakh 60,000. In this 41 lakh 60,000, you have to reduce index cost of acquisition. That is 8,500. 8,50,000 divided by 100 into 331. It is 28 lakh 13,500. So what do you get? 41 lakh 60,000 minus 28 13,500. So it is 13 lakh 46,500. So in that, you less 54 EC because it is invested within 6 months. So you take this 4 lakhs. So 943,500. So in this you take, yes, purchase one residential house. So it's a plot and a residential house. So it is 54F. So what will be for 54F? We'll have to take this consideration, that is 1343,500 is for how much? Is for 42 lakhs. Is for 41 lakh 60,000. 41 lakh 60,000. How much is it for? What is he invested? He has invested 6 lakhs. So you take this proportion, right? So you take how much is it for 13 lakhs. So whatever is invested, you take this 13 lakh 43,500 is your total gain. On the total gain, the sale consideration is 40 net sale consideration. What you have to take here is net sale consideration. So that is 41 lakh 60,000 into whatever he has invested. That is, he has invested 6 lakhs. So what will be the answer? 1343,500 divided by 41 lakh 60,000. 1343,500 divided by 41 lakh 60,000 into 6 lakhs. So that is 1,93,774. So the answer will be 943,500 minus 193,774. 749,726. So 7,49,726 will be your will be the answer. That is, will be your long-term capital gain. So again, you have to write notes everywhere, wherever required. So whatever notes you write is very important. So I've been repeatedly telling this. So please make sure you are writing notes. So we'll go to question 4. So what is question 4? So question 4 is basically again on capital gain. It is on 1st August 2017 6. 1st August, I'll first see if there are any queries on 1346,500 is it? Oh, sorry. So you correct that. Let me not revert. So this should be not, this is 1346,500, and so this will also change, this will also change. So as I told you, whenever you are working this, make corrections in red. So when you make corrections in red, that you know that you made a mistake. I don't have an option here because I myself have written it in red here. So anyways, I can do the different thing and say that, let's say that this is not 43, it is 46. This is wrong, and write the correct answer. I can still do here, but let's assume that when you're solving a problem, solve it with the right numbers. Whenever it's very human to be careless, to make careless mistakes. But when we keep working, we tend to not make that mistakes again. So how do you know that you have made some mistake? Mark it in a different color so that your mind registers that you have made a mistake. Next time when you are writing this sale consideration, you will write the exact number. You look at the number and write it. So you will not make that careless mistake. So these are small tips that will help you bring the right approach in writing the examination. So thank you, Aslam, Abdul, and Gomati for correcting that. So it is 1346,500 and not 1343,500. Okay. So we'll move on to question 4. So question 4 is basically on 1st August 1976, M has purchased 400 shares of ARC Limited at 100 per share. On 31st December 1980, ARC Limited issues bonus shares. Mrs. M was allotted 600 bonus shares. So now what are they saying? They are saying Mr. M purchased 400 shares on 100 per share. On 31st December 1980, ARC issued bonus shares of 600 bonus shares. The FMV was 600 per share. So now we need to understand what will be the FMV for bonus share, what will be the FMV for regular shares that he purchased. On 3rd October, he sold all the shares for 1,000 per shares at 1,000 shares. That is 400 share plus bonus of 600 shares. So both put together 1,000 shares. He has sold everything put together for 2,200 per share and paid brokerage of 2% on sale of consideration. Out of sale consideration, she invested 4 lakh in a residential house which was completed before 30th June 2023. Compute the taxable income assuming that she does not own any other residential house and not sold through residential stock exchange, not sold through recognized stock exchange. So we need to index all this. So as we said, it's a basic indexation thing given. It will be 100 and 331. So 100 is for base year of 2001-2, and 331 will be for the base year of 2022-23. Correct? So that will be your base year. So now whatever you need to do, we need to first we need to understand what will be the cost for regular shares, what will be the cost for bonus shares. So for bonus in section 55, we saw that before 1st April, that is before 1st April, before 1st April 2001, it will be FMV. After, on or after, it will be the cost. So whatever cost, whatever is the fair market, whatever what you call, sorry, it will be zero. When you say cost, it is zero, right? So on or after 1st April 2000, the value of bonus shares will be zero. Here it is about, he has purchased it, right? So he has purchased it. So let's say sale consideration is 2,200 into 1,000. Correct? 2,200 to 1,000. And cost of acquisition, there's also bonus and all, brokerage and all, so we'll solve it itself. So which problem it is? 4. Compute capital gain of Mrs. M. Of Mrs. M for AY 2023-24. So I write particulars. Okay, so what we'll do is we'll start with sale consideration. Sale consideration is 2,200 into 1,000 shares. So there will be 22 lakhs, right? Okay, then less brokerage at 2%. So 2% will be 44,000, correct? 44,000. So it will be 21 lakh 56,000 less cost of acquisition, correct? It is 600 into 1,000. You have to write this in a note. What is it for regular share? What is, how did you arrive? 600 for every share. So that we need to write. So it is 6 lakhs, right? I'm sorry, it is index cost of acquisition. So we have to do index cost of acquisition. So this divided by 100 into 331, correct? Because it is 600 per share on 1st April 2001. Since it is needs to be indexed, we need to do, so it is 6,000 into 331. So it is 19 lakh 86,000. So it is correct. So is that right? 6,000 into 3. So 19 lakh 86,000. So you get 1470, 170, right? 1 lakh 70,000. Just correct me if it's wrong. 1 lakh 70,000. Now this will be your net sale consideration. And this, from this you reduce. There was an investment, right? There was an investment. So it is basically construction of residential. So when it's construction, it is 3 years. So out of sale consideration, she invested 4 lakhs in the construction of residential house, which will be 3 years. So of course, 3 years is before 30th June. So need not deposit and all. She can straight away do it. So what is it now? Now it is less exemption. It is a share. So sell something other than residential house and invest in residential house. Exemption under section 54F. 54F. So what will be the exemption? Take the sale consideration, that is capital gain, that is 1,70,000 divided by total net sale consideration, that is 21,56,000 into what? Into the investment made, that is 4 lakhs. Correct? You can always write a note for this also. So it will be 1,70,000 divided by 21,56,000 into 4 lakhs. So it is 31,540. So 31,540 will be your long-term capital gain. So long-term capital gain will be how much? 1,38,460, correct? 1,38,460. So that will be your capital gain. So and that's what exercise 4, right? Exercise 4. Okay. So exercise 5. I think it is half written. Probably I'll complete it during the break. I think I've not given the full thing. So we'll skip to exercise 6. What we'll do is we'll just go through the problem. This is a problem from the suggested answer in December 2022. We'll go through the problem and then start solving. So first thing is Ms. Mishika has entered into an agreement with CVM Build Limited. Okay, CVM Build Limited on 25th April 2017. So what do you now understand? So it says it is entered into an agreement with the builder. So what is it? It is joint development agreement. We saw a different approach for recognizing capital gain under exceptions in section 45. So generally capital gain is taxable in the year of transfer, but for certain cases, capital gain will be taxable in the year of receipt. So similarly in joint development agreement, capital gain will be taxable in the year of registration or completion, certificate of completion, whichever is earlier. So this is the concept. So when you read, first you understand what is the base section that we are going to work. So we are going to work basically on this particular provision of 45. So in which she agrees to allow such company to develop a shopping mall on land owned by her. So land is someone is developing it. She purchases land. So the cost of her is 15 lakhs. So in May 2009, she has invested 15 lakhs. In consideration, the CVM Build Limited will provide 20% share. 20% in share of shopping mall. So whatever is the value of shopping mall, she will be owning 20%. The certificate of completion was issued on 26th December 2022. So she has entered into an agreement in 2017. So the capital gain does not arise in financial year 2017-18. So it will not arise in 2017-18. So this is what? Previous year 2017-18. Capital gain will not arise here. Capital gain will arise in this particular year. This particular year, I think I'll just delete this. So which year are we talking about? So it is basically this year, 26th December 2022. That is nothing but previous year. 22, 23, and assessment date 23, 24. So this is where you need to recognize your capital gain. On such date, the stamp duty value was 4 crore 14 lakhs. 4 crore 14 lakhs. Subsequently, on 18th March 2023, she has sold a 15% share for 65 lakhs. Correct? 65 lakhs. Now she has also purchased a house on 9th May 2022. When is he purchasing? 9th May 2022 for 46 lakhs and occupied for her own resident. For her own resident. Punjab National Bank has sanctioned a loan for 35 lakh 50,000, 80% of stamp value at the interest rate of 12% per annum on 1st May 2022. So there is a loan that is provided. She does not own any other. As I told you, it is important, right? Date of sanction. So there is cost of indexation given. There is 910 is 148, the year in which she purchased the land, and finally the 331. So they wanted to compute the gross total income. Now, actually, the suggested answer wanted to provide your net total income only, but since Chapter 6A is not yet covered for you, I have stopped with the word gross total income. So, just a deviation from the suggested answer question. So, what we need to compute is only gross total income, correct? So, what I suggest is try solving this. Try solving this. We'll take a short 10-minute break, but the 10-minute break, my thing is just take very few minute break and try solving this for the next few minutes, and we will resume probably in another 10 minutes, and then we will continue this. So try solving this problem. We'll discuss this after 10 minutes. So see you after a short break. Yeah. So when you one of you started working this problem, okay. So we will just take it forward. We'll take it forward from where we left. So we were reading the question, right? So typically it's about the joint development agreement. They want to understand the gross total income of Mishika. So the first thing that comes to mind is it uses the word it was occupied for our own residence. So it's a self-occupied property. So what comes here is house property also comes into picture, not just your capital gain. House property also comes into picture. So what we have to do is we need to start with house property. File, compute gross total income of Mishika, right? Of Miss Mishika for assessment year 2023-24. Okay, let's start with particulars. Amount, and then a reference column. Okay. So we start with okay. So we'll start with the first thing, income from house property. So from income from house property, first thing is a gross annual value less municipal tax, whatever. Being a self-occupied property, the net annual value is straight away nil. Will straight away be nil. Less, of course, there is no that standard deduction of 30%, but you can take interest on housing loan. Interest on housing loan. So what does it say? It says it has been taken from Punjab National Bank for 35 lakh 50,000 at the interest rate. There is also a word say 80% of stamp value, correct? So we should also compute that if 35 lakh 50,000 is 80 percentage, what is it 100%? That is, it comes to 44 lakh 37,500. Why is this word important? Why is this 80% of stamp value important? Because if your stamp value is higher than the purchase consideration, you have purchased it for 46 lakhs. If your stamp value is higher than this 46 lakh by more than 10%, then that difference will be what? Income from other sources. Please understand, it's like a small word in your question. It says 35 lakh 50,000 is the loan amount and it says 80% of stamp value. Now, if you actually look at it, if you take reverse work it and find out the stamp value, it becomes 44 lakh 37,500, which is less than the sale consideration. It is okay. If your stamp value is higher than the sale consideration, what did we read from the income from our sources? From the perspective of buyer, if I'm purchasing a property less than stamp duty value by more than 10% or 50,000, whichever is more, we saw that, right? If that is more, what is the section? 56 to 10, right? When there is a transfer of immovable property without consideration or with consideration, which is not appropriate. So that difference, that is 10%. 10% of such is what the limit. If it is below that, the whole difference will be treated as income from other sources in the perspective of buyer. So for Mishika, it is still less than the limit only, so it's okay. So the loan is 35,50,000 at the interest rate of 12% per annum on 1st May 2022, and disbursement was made on 1st June 2022. So we need to compute interest. How many months? From June to March. So it is 10 months. So April and May is ignored. From June to March is 10 months. The total loan amount is 35,50,000. So 35,50,000 into 12 percentage into 10 divided by 12, correct? So what will be the amount? 35,50,000 into 12 percentage for 10 months. That is 3,55,000, correct? But how much is it restricted? So you can write a note. So restricted to how much? 2 lakhs. You can always write a note below, or even here itself. You can write here saying that the maximum interest eligible under section 24B is, clause B is 2 lakhs. So the interest is restricted to 2 lakhs. You can always write in your solution itself or in the below, whatever it is. So loss from house property is 2 lakhs. Right? So the maximum loss is from 2 lakhs. Next is, we need to compute the next head. The next head is long-term capital gain, correct? So the long-term capital gain is 2. First, basically, the capital gain is 2 numbers. First is, she has sold her 20%, that is the completion certificate. The certificate of completion is obtained on December 2022. So you have to recognize this sale. You have to recognize this sale in previous year 22-23, that is assessment year 23-24. So we have to take the sale consideration. So what is the sale consideration? %20 in mall, right? So what is the mall value? They have given the mall value as 4.4 crores. They have 4.14 crores. So the 4.14 crores is the total thing. 20% is her share. So that will be your sale consideration. Whatever she's getting is 20% of the mall. So we have to compute 20% into 4 crore 14 lakhs. So 4 crore 14 lakh will be what? 828, right? Into 20%, that is, yeah. So 82 lakh. I'll write it in the inner column. $82 lakh 80,000. In this 82 lakh 80,000, you need to now less the index cost of acquisition. Index cost of acquisition. So the index cost of acquisition is, she has purchased in 2009, 15 lakhs. So 15 lakhs divided by 148 into 331. So it is 15 lakhs divided by 148 into 331. So 33, 54, 730. 33, 54, 730, correct? So this is what she has invested. So 33, 54, 730. So it will be 82 lakh 80,000 minus 3354 730. So that is 49 lakh 25,270. In this, what is happening is, in this 49 lakhs, now she is eligible for exemption. This is a plot, right? Remember, it is a plot. Might be the sale consideration is of that of a mall 20%, but what she has actually sold is a plot of land. So when you sell a land, when you buy a residential house, it is 54F. So what she has done is she has purchased. She also purchased a house on 9th May 2022, which is 1 year before, 2 year after. So she has actually sold it in December 22. So 1 year before, she has purchased it in 1 year before. So she is eligible to claim that. So less exemption under section 54F, right? As far as this 54F, now what is the situation? The total gain, that is 49 lakh 25,270 out of total sale consideration of 82 lakh 80,000. So this proportion, you take this proportion into whatever she has invested. How much she has invested? She has invested 46 lakhs. So 49,25,270 divided by 82 lakh 80,000 into 46 lakh. So 27, 36, 261. Okay. So that will be a gain. So her long-term capital gain will be 49 lakh 25,270 minus 27, 36, 261, correct? 27, 36, 261. That will give 21 lakh 89,009. So this is a long-term capital gain. Now this long-term capital gain will automatically be used for setting of that house property, that is 2 lakhs. So the 2 lakh will get set off with 2189,009. So your long-term capital gain will become 1989,009. So what will be taxed at 20% will be 1989,009. Okay, next is, now she is again selling it, right? She is selling it in the same year. That is, she is selling it on, she is selling at this share, that is mall share, whatever building she has, she is selling it. So when did she actually, the thing is 26 December 22 only. She has claimed 26 December 22, but she is immediately selling that in 18th March 2023. So this will become like a short term, because this thing, whatever it is, that is whatever she has got this small 20% share, she got only in 26 December 2022. Now he is selling it immediately in what you call 18th March 2023. So now it will be a short-term capital gain. So what is a short-term capital gain? So this will be 2189, not 9. This will be 2 lakhs, correct? So now sale consideration. You have to write short-term capital gain. So this is, you, as I told you, you have to write the headings everywhere. So this will become income from capital gain. So this will be a heading. Under that heading, you can write 1, sale of plot. Number 2, sale of share in mall. Okay. So what is the sale consideration? What is the sale consideration? The sale consideration is 65 lakhs. So she has sold it for 65 lakhs. Less cost of acquisition. Cost of acquisition is what? 15% of 4 crore 14 lakhs. 15% of 4 crore 14 lakhs is your cost of acquisition. So 15%. So they're saying that out of 20%, she is selling 15%. So that is 4.14 into 15%. So that will be 62 lakh 10,000. So short-term capital gain. Short-term capital gain will be 2 lakh 90,000. So her gross total income will be how much? So as I told you, this 2189 will be adjusted with the long term will be adjusted with house property loss. So it will be 1989 not 9 plus 2 lakh 90,000. So 2279 not 9. You have to keep in mind the adjustment of house property loss. Of course, it's a separate topic by itself, so that will be discussed to you in a separate class. As of now, just remember income from house property is set off with long-term capital gain. So now the total gross total is 22 lakh 79 not 9. So clear in that. So that is exercise 6. So now I said that the exercise 5 was half baked. So what we'll do is we'll try to complete that exercise 5 now. So I filled it up. So exercise 5 is also on capital gain. So basically Mr. X owns several assets but does not own any residential house. So what do you mean? If there is some investment on residential house, he is eligible for 54F because he does not own any residential house at all. So he sells the following assets and requests you to compute his capital gain. So shares purchased in April 2002 for 1,14,000. So shares purchased is for 1,14,000. Sold through recognized stock exchange on 15th December. So for 2 lakhs. So the sale consideration is 2 lakhs. The FMV on that date was 2,20,000. So you'll have to calculate the FMV because it's sold through recognized stock exchange. On 1st April, he agreed to sell 11,92,000, which was purchased for 8 lakhs jewelry. So is jewelry a capital asset? Yes. However, the sale could not be affected as Y backed out. But the question is not talking about any forfeiture of money. If it's forfeiture, the concept of 31st March 2014 comes into picture. So till 31st March 2014, it must be adjusted with cost of acquisition. From 1st April 2014, it must be treated as income from other sources. He now sold the jewelry for 38 lakh 20,000 and incurred 20,000 incidental on brokerage and commission. He also invested 1 lakh 50,000 in a deposit of the public sector bank. He also purchased a small residential house of 3 lakh 90,000. So he has purchased a house for 3 lakh 90,000, deposited 1 lakh 50,000 in capital gain account scheme. Debentures unlisted sold for 1st December 2022 for 80,000. So debenture is also sold. So next is sold his motor car on 15th March 2022. So he has sold a motor car. So motor car is a capital asset, not a capital asset? No, right? So only if it is depreciable, part of depreciable asset, it may get covered. Otherwise, it doesn't get covered. So sold as motor car on 15th March 2022 for 80,000. So that's what it is about. So now we have to compute the capital gain. So fifth problem, right? Okay, this was 6. So this was 6. Now we are going to solve fifth problem. So compute capital gain of Mr. R for assessment year 23-24. So again, you have particulars amount reference column. Okay. Okay. So with this, so first is what? So I will treat it as one sale of shares, right? Sale of listed shares. So that is one. So sale consideration. So your sale consideration is 2 lakhs. Sale consideration is 2 lakhs less cost of acquisition. You have to write it down because it is cost, whichever is higher, cost, and whichever is lower, fair market value or sale consideration. So cost, fair market value, and sale consideration. So what is the cost? Cost is 1.14. So cost is 1.14. Fair market value is 2.2. 2.2 and this is 2. So your answer will be 2 lakhs. Correct? So cost will be 2 lakhs. So whatever it is, you treat it as nil. So your capital gain on listed shares. Okay, next is 2. 2 is jewelry. Sale consideration. So how much is sale consideration? Sale consideration is 38 lakh 20,000. Less expenses. 20,000, right? 20,000. So your net sale consideration is your net sale consideration is 38 lakhs. Now on that, he also invested 1,50,000 on that and then 3,90,000. So now we need to calculate cost of acquisition. So jewelry's cost of acquisition in 2001 was 11,92,000. So this 11,92,000 is what is being sold now. So the 2001. So as we said, remember the base years. So 100 and 331 less index cost of acquisition. So what will be 11,95,000 divided by 100 into 331. 11,95,000, right? 11,92,000. So 11,92,000. So 11,92,000 divided by 100 into 331. That is 39,45,520. 39,45,520. So it's a loss. So considering this is a old question, what I will do is I'll just increase the sale consideration because we'll make this. Okay, let's leave it. So 39,45. So the loss. So the loss from sale of jewelry will be 1,45,520. Correct? 1,45,520. The third one is debenture. So sale consideration. So debenture sale consideration is 80,000. 80,000 less cost of acquisition. There is no indexation for debentures. So you'll have to write a note. So you have to write a note for here. You write a note for this, and then you write a note for this. No indexation. So you take 50,000 as it is. So 30,000. So 30,000. Now it says that purchased a small residential house for 3,90,000 and additional capital in account scheme of 1,50,000, total of 5,60,000. So she is eligible to claim 54F, right? Because it's debenture sale, she is purchasing a residential house. What she has purchased is a residential house. So total of 5,60,000 is eligible. So what we do is so total of 5,60,000 is totally eligible for her in 54F to compute. So less exemption under section 54F. So what do we do in 54F? We take 30,000, we divide it by 80,000 into total investment, that is 5,60,000, because 3,90,000 in a house, 1,50,000 in the investment scheme. So that can be used later point in time. So till it is not used, it will be lying in capital in account scheme. So that is what is there. So you have to take this concern. So now you will be eligible for 30,000 itself, maximum of capital gain. So now what will be the thing? This will be nil. Correct. So totally there is a loss of 1,45,520. So total loss will be 1,45,520 in this. Okay. So that's it about exercise 5. Motor car is not an asset, so we will not be considering. Why is income from other sources excluded? Where was it excluded? If it is in Mishika, there is no income from other sources for Mishika, so it is excluded. Because she has not received any interest income or whatever it is, so it is excluded. Why the 30,000 of debenture is only considered and not net consideration? See, he has earned 30,000 gain from this. So this is the net. 80,000 is what is being sold. 50,000 is 50,000 is the cost. So your capital gain from that is 30,000. So there is no net consideration there. So there is no expenditure here to arrive at net consideration. So the 30,000 is straight away the thing. So I think that's what you're asking. If that is what you're asking, there is no net consideration because your sale consideration minus expense is your net consideration. There is no expense. So we have straight away considered the 30,000 for calculating. So we will move on to other question, that is IFOs. Following details have been furnished by Amali pertaining to the year ended 31st March 2021. So capital cash gift of 51,000, cash gift of 51,000 received from friend on the occasion of Sashipta Purti, that is 60 years of age. So it's completion of 60 years of age. They are receiving this award of gift from friend. How much is it? 51,000. So now there are two things that we need to keep in mind. One is for what reason they have received. It is not wedding. It is not wedding. So the next thing is how much is the amount? It is 51,000. So moment it is 51,000, what happens? It is above 50,000. So it automatically gets taxed, correct? So this 51,000 will be straight away taxed. Next is on the above occasion, a diamond necklace of 2 lakh was presented as sister. So it is received from her sister. So since it is from sister, it is not taxed because it is relative. We said if it is received from the relative, it is not taxed. So it is automatically not included. So 51,000 is taxed. So this is taxed. And this is exempt because it is from relative. We have to tell the reason also. So when she celebrated her daughter's wedding on 21st February, her friend assigned in Mrs. Amali favor a fixed deposit held by the said friend in a scheduled bank. The value of fixed deposit accrued interest was 52,000. Now, what happened is they say that celebrated on a daughter's wedding. So they say it is not her wedding, it is daughter's wedding. So it is only available for exemption, only it is if it is own wedding. So this is also taxed because there is already a cash more than 50,000. Now what happens is this 51K and 52K will be taxed and others will be exempt. So totally this was it is there. So 51,000 plus 52,000 will be 1,03,000. Now one more thing that we need to keep in mind is what is being presented as fixed deposit, right? What is being presented as fixed deposit? We said there are three categories of gift. One is sum of money, another is immovable property, third is movable property. So your properties are also defined. Properties does not include fixed deposits and all. So properties does not include movable property, does not include fixed deposits. So the question is whether the sum of money includes cash alone or cash equivalents also. We discussed this. So we said there are two views. You can assume that cash equivalent is also cash. You can also assume that cash equivalent is not cash. So whatever it is. So if your question is about fixed deposits, you can take both the stands. So what I suggest is treat it as cash equivalent. Treat it as cash equivalent. So write in notes. Follow uniform stand. So write in the note saying the cash equivalent is considered to be a cash, a sum of money, and hence considered as taxable under income from this other sources. So you can always take a stand. So both the stands are encouraged. So the provisions will be like it is either considered as cash or not cash. We will take a stand that it is cash. So if it is considered as cash, it is 1 lakh 3. Otherwise, this 52 will not be discussed at all because it is not sum of money. So both the views are there. So I suggest fixed deposit is considered as sum of money and you include it as PAB. So always follow the stand. So you need not write both stands in your examination. In examination, follow one stand. Say that this 52,000 is eligible because fixed deposits is also sum of money. Okay. Next thing. So we'll move on to the next question. Examine the following transaction. B transferred 500 shares to B and Co on 1010 Limited and the market price was 5 lakhs. The index cost of acquisition for B was 4,45,000. So the index cost was also given. The transfer was not subject to security transaction tax. Determine the income chargeable in B and Co. in both hands. We said when something is transferred, it must be transferred at the fair market value. So if something is transferred less than the fair market value, the difference will be treated as the income in the hands of the buyer. So that's the first thing. So the next is, so it only requires the examine the following transaction. So we'll see what is the first thing. So whatever it is, the actual value is 3 lakhs, but the market consideration is 5 lakhs. So which means 5 lakh, we'll have to see whether it is less than 10% or 50,000, whichever is higher. In this case, being 5 lakhs, we said the cutoff is 5 lakhs. So in this case, both, it will be 50,000 only. So 10% will be 30,000 for 10% of the consideration. So 10% of consideration is 30,000, whereas your actual market price is 50,000. So in this case, 5 lakh minus 2 lakhs. 5 lakh minus 2 lakhs. 5 lakh minus 3 lakh. 5 lakh minus 3 lakh, that is 2 lakh will be a difference, right? So what happens is, for in the hands of B, sale consideration will be 5 lakhs. Sale consideration will be 5 lakhs and index cost of acquisition will be 4.45 lakhs. So balance 55,000 will be treated as the capital gain in the hands of B. In the hands of B Co Private Limited, 2 lakhs will be treated as income from other sources. So for B Co, 2 lakhs will be treated under IFOs because it is lower than the market value. So this is 56 to 10, correct? So under 56 to 10. So this is the section for gift. 56 is the section for income from other sources. 56 to list out all the incomes that are taxable under income from other sources. 10 is for gifts. So these are common things. Okay, 10 is for gifts. So 2 is for the charging section, which talks about the list of income from all sources. 56 is the section. 56 subsection 2 and subclause 10 is what is covered here, right? Next is Mr. Chalin is employed for the company in the taxable salary income of 5 lakhs. He received a cash gift of 1 lakh from Atma Charitable Trust. So typically when an income is received and a sum of money is received from a registered trust under section 12AB, it is not taxable. We saw various exemptions where it is not an income even if it is a gift. So one of them is trust under section 12AB. So registered trust providing a sum of money for medical expenditures is not a taxable expenditure. It's not a taxable income under the hands of Chilean. So in this case, it is not taxable. Why? Because it is from registered trust. So hence it is not taxable in the hands of Chilean for medical expenses. Correct? So this is about your exercise 8. Moving on. There is a question from RTP May 22, which talks about both capital gain and IFOs. So what does it actually say? It talks about Asiana developer has completed one of its housing projects. So what exactly does it say? It says in Gurugram in January 2022, which comprises of 10 residential units, out of which 9 has already been transferred. 9 has already been transferred in February 2022. So in February 22, 9 units have been transferred and remaining 1 residential unit in May 22. So that's only falls in financial year 22-23. So this only falls in financial year 22-23. To Mr. Suraj. All the units were transferred by way of first time allotment. The consideration received from the Suraj for residential units is 50 lakhs. So the consideration is 50 lakhs, while the stamp duty is 57 lakhs. Due to some emergency in the family, Mr. Suraj was in urgent need of funds and he sold such residential unit to Mr. Prakash in December 2022. So he is again selling it to Prakash now for 53 lakhs. The stamp duty value of the unit was 61 lakhs in December 2022. So what is happening? We need to say how much will be taxable in the hands of Prakash, how much will be taxable in the hands of Suraj. Now, the first thing is, we are talking about 22-23, correct? 22-23. So here Suraj is actually buying this property. So Suraj is actually buying this, has bought this property in this particular year. And what period is he has taxed? He has purchased it for 50 lakhs, correct? 57 lakhs. So in this period, what is happening is, whatever is the consideration received, that is Suraj is a buyer here. Suraj is buying from Ashiana developers. So Suraj is buying at what price? He is actually buying it at 50 lakhs. So this is his cost. But the stamp duty value at that period was 57 lakhs. So if you take 10% of 50 lakh, it is only 55 lakhs, correct? So it is more than the purchase cost. So for Suraj, in that particular year, this 7 lakhs will be IFOs because he has purchased it. He has purchased it at a higher price. Instead of 57 lakh, he is only purchasing it at 50 lakhs. So the 7 lakhs has to be treated as IFOs. And again, he is selling it at 53 lakhs when the stamp duty value is 61 lakhs. So when he is computing the sale consideration, he will compute sale consideration as 61 and cost of acquisition as 57, whatever is considered. So this 4 lakhs will be his capital gain, will be his short-term capital gain, correct? Now, during this actual for Nance of this is Nance of Suraj. During the sale time, that is Prakash is buying, right? Prakash is buying, cost is 53, stamp duty value is 61. So this 8 lakhs, the difference of 8 lakhs is what? Is IFOs in the hands of Prakash. So it is 8 lakhs under IFOs in Prakash hands, and then 11 lakhs, that is 4 lakhs as short-term capital gain in the hands of Suraj, 7 lakh as short-term capital gain in IFOs. So this will be there for assessment year 23-24. See, in the earlier, there was another provision where it gave some relaxation for, instead of 10%, there was a relaxation of 20%. That is, we are talking about 10% cushion, right? 10% cushion in stamp duty value. Till earlier year, there was a cushion of 20% for specific period. So if you are solving any previous year questions, there is no 20% available right now. It is only 10%. So 10% alone is available. So if you are trying to solve previous year questions, there might be a cushion available for 20% instead of 10%. We saw that in that our example also. So if it is 20%, only then it can be claimed as, in this case, it is more than 20%, correct? So 50 and 57 lakhs, it is more than 20% in that case. In that case, there is no such income and here it will become, sorry, this will be 61 only, and here it will become 50. So this will be 11 lakhs. So 11 lakhs will be calculated, 8 lakh will be. So if you're taking the 20% cushion, then it will be 11 lakh will be capital gain and 8 lakh will be IFOs for this particular person. So with that, we will have both the numbers. That is for Suraj, it will be treated as 11 lakhs. For Prakash, it will be treated under how much? It will be treated as 8 lakhs. That is 61 minus your 53 lakhs will be your 8 lakhs. So that's what it will be for Prakash and Suraj. For Suraj, 11 lakhs capital gain, and for Prakash, it is 51 lakhs. So this is what you have to calculate it from the perspective of buyer. We are only talking from the perspective of buyer because whatever was sold from ASEAN and developer is not question. Question wants us to know only with respect to Suraj and Prakash. Correct? Okay, moving on, we'll move on to the next thing. So next thing is last question. So we'll have the last question. So it is from RTP November 2022. I'll see if there are any questions. Yeah. Okay, next thing is IFOs. Cash gift of Mr. Ramesh. Mr. Ramesh, a property dealer, has developed an independent floor. Of 4 residential units. You sold one of its residential unit to Mr. Vikash, who's dealer in spare parts. So he's a dealer in spare parts for 55 lakhs. So he has actually sold it for. So he has developed 4 residential unit. He sold one for 55 lakhs on 1st June 2022. The agreement was, however, entered on 1st June. So the agreement date is for 1st April, but actual sale date is Mr. Ramesh had received a drawn down payment of 5 lakhs on account paycheck. So on the date of agreement, he has already received 5 lakhs. So which means the date of agreement only is relevant, not the date of registration, correct? So date of registration, Mr. sold 3 remaining to Raj, Ashok and Ashish for 60 lakh. All the unit was transferred by way of first unit allotment. That is, it's their first home. So that's what you mean by first time allotment. So in this first time allotment, the word first time allotment, we saw that in income from other sources only. Whenever you take that instead of 10%, you take that cushion of 20% if it is within a period till 30th June 2021. So within that period, you take that cushion of 20%, correct? So that is what we discussed there. So that is why they are mentioning as first time allotment in several cases. The stamp duty value at the time of 1st April 65, 1st June is 68 lakhs, 1st June is 68 and 1st December is 70 lakhs. So now we need to compute each of this case. So discuss the tax consequence of each of the situation of all these 3 persons. That is Vikas, Raj, Ashokan, or all 4. Vikas, Raj, Ashokan, Mr. Ashish. So now that's what we are trying to solve. So basically from the answer of Mr. Vikash, we have to see how it goes. So basically, we are talking about Ramesh, right? So Ramesh is a property dealer. So we said he is selling a residential unit for 55 lakhs. So for Ramesh, the sale consideration is 55 lakhs. The relevant date for Ramesh to calculate the stamp duty value is since he has received 5 lakhs as account pay check, what happens is he has to consider this date, that is the registration, the agreement date is what is relevant. On agreement date, it was 65 lakhs. So your consideration is your stamp duty value is 65 lakhs. So it is more than 10 percentage. Hence, you have to consider 55 into 65 lakhs. That is more than 10 percentage. So what happens is the sale consideration for Ramesh, the sale consideration for Ramesh will be 65 lakhs. So the sale consideration will be 65 lakhs. So that's what it is about. So it says that whenever you're taking the sale consideration, you have to take that 110%. We saw that. So only if it is within the period 12th November 20 to 30th June 21, we have this question of 120 percentage or 20 percentage. So this is in capital gain, this is in IFOs. So in capital gain, we said if stamp duty value is more than 120%. So the only if it is within this period. So if it is after that period, it becomes what? 110 percentage and 10 percentage. So mostly in previous year 22-23, that question will be very rare. Only if it is questioned there. So we say, if it is not there, you need not bother. What you have to remember is only 10 percentage. So only if it is between this 12th November 2020 and 30th June 2021, the concept of 20 percentage comes into picture. Otherwise, it's always 10 percentage. So in our case, it is only 10 percentage. So in our case, it is only 10 percentage. So in this 10 percentage, what happens is now under the hands of Vikas, the sale consideration will be 65 lakhs, not 10 lakhs, 65 lakhs and not 10 lakhs. So not just that property, even in the other property, he has sold the other 3 properties for 60 lakhs on 1st December. On 1st December also, the amount is 70 lakhs. So in that case also, the sale consideration will be 70 lakhs. The sale consideration will be 70 lakhs because of the stamp duty value, correct? So in all these cases for Ramesh, the sale consideration will be 65 lakhs for the property sold to Vikas, and for the rest of the time, it will be 70 lakhs. That's what. For Vikas, what is he doing now? Vikas, in the hands of Vikas, the difference between the stamp duty value and sale consideration will be treated in income from other sources. So now how much is it for Vikas? It is 65 minus 55. So 10 lakhs. 10 lakhs will be treated as an income in the hands of Vikas. In the hands of Raj, Ashok and Ashish. For all 3, it is 60 and 70. So for them also it is 10 lakhs. For all of them, the 10 lakhs will be considered. For all of them, the 10 lakhs will be considered as 10 lakhs for the purpose of will be treated as income from other sources. This will be treated as income from other sources. And for the sale consideration, it will be treated as this 70 lakhs will be treated as sale consideration. So please understand, it is only 10% at this point in time. Earlier, only during this period, it was 20%. So if you are looking at the earlier questions, there might be a situation where you might have to consider 20%, but mostly for your previous year 22-23, it will always be 10%. So that is your RTP for this question. So as I told you, what you need to give importance is to the period of acquisition. If your period of acquisition is between 12th November 2020 and 30th June 2021, the provision stated not 10%, it was 20% earlier for both capital gain and your income from other sources. If you actually look at it, our slide in income from other sources, we would have quoted that during this period, we'll have to consider 20% for first time allotment, not for every asset that we are talking about, only for first time allotment. So for first time allotment, we'll have to consider 20% and not 10%. So please understand this variation. Otherwise, 56-10 only talks about 10% and not 20%. So please keep this in mind while solving your problem. So I think that's what I wanted to convey for these problems. So typically it is like, you have to keep in mind for all these things while solving a problem. As I told you, first read through the problem, visualize on what exactly you need to do in the problem, what adjustments, what provision, just keep that in mind. probably start making a small mark in your question paper. It is okay in pencil, preferably. Don't write anything because you're not supposed to write in the question paper. So preferably have a slight mark for you to understand. If you need to make an addition, you can put a plus. If you need to make a reduction, you can put minus. Small things that you can mark it in the question paper, and then start visualizing what exactly you need to do in the problem and then solve it out. So that's what it is all about, this problem. So with this problem, I'm basically completing my session for the day. So I think we have covered all the three chapters, that is PGBP, capital gain and income from other sources. We have solved various exam problems, how you will be tested in exam. We also had one scenario based MCQ. That is how your MCQ is tested. So you'll be given a short story. Based on that short story, you will be asked for 5 MCQs. So try to understand the question and then start answering. So please make sure that you give importance to notes. As I told you, notes only will help you. Let the valuer know that you know the provision. It is very important. Please keep this in mind. Notes is very, very important for income tax. So with that, I'll end my today's session. Thank you all for the wonderful session. We'll see you later. Thank you.